Hi, all. Thanks for joining us today. My name is April. I'd like to introduce today's webinar, Avoiding Audit Surprises in Thailand, What CFOs and Founders Need to Know Before Year End. Our speakers today will be Som, the Managing Director of Acclime Thailand, and Christina, the Advisory Service Director of Acclime Thailand. Before they get started, I'll give an overview of what this session will include. Today, our speakers will go into detail about audit risks in Thailand, including the top audit risks for Thai SMEs and startups, common causes of audit delays and findings, what first-time audits really involve, and how Thai audits impact banks, investors, and group reporting. This will be followed by a live Q&A at the end where Som and Christina will answer any questions from our attendees. Please see the Q&A button at the top of this webinar. You are welcome to click on that and leave your question at any time, but all questions will most likely be answered at the end of this session. If we run out of time, our team can contact you after the webinar to answer your questions directly. I'm now going to give the floor to Som, who she'll be starting with the topic of why auditing is important today.
Good afternoon, everyone. My name is Som Ponpan Kistenvega, the Managing Director of Acclime Thailand. So today I want to invite you to talk about why the audit is matter right now. So apart from we're talking on the compliance, I want to talk about the importance of us being the management or the CFO looking the audit, because it's not only the compliance that we do it by the end of the year, but actually the audit can help us to prepare, and it will help us to make a good decision over our business. And it shows the transparency between us in the HQ, the headquarters of the company, and all the related party that we are going to work with. So today, we are going to talk about how to prepare about it, because many of time we figured out that the errors or inconsistency we found out at the end of the year. So we are going to talk how we are going to prevent that. Next slide, my co-worker Marek is going to walk you through the first session of today.
Thank you, Sam. Good afternoon, everyone. So I'm Christina. I'm the Advisory Director in Acclime Thailand. So let me walk through with you what are the realities of the statutory audit in Thailand. So basically, Thailand, like any other country, is required to file its annual return at the end of the year or 150 days from the closing of its accounting books of accounts. So basically in Thailand, you have the TFRS. The TFRS is the Thailand Financial Reporting Standard, which is adopted from the IFRS, which is the International Financial Reporting Standard. But then again, in Thailand, if you are a private entity or a listed entity, there are two reporting standards. For a publicly accountable entity, you will have to use the TFRS for publicly accountable entities, while if you are a non-publicly accountable entities, you will have to use the TFRS for the NPAE or non-publicly accountable entities. Another thing in Thailand is you are not just submitting your accounts or financial statements or corporate accounts with the revenue department. You are also required to submit them with the Ministry of Commerce under the Department of Business Development. Another thing is the revenue department. You just don't submit a corporate income tax return, but certain industries, let's say, for example, if a company is a BOI promoted industry with tax exemption, you are also required to indicate in your tax return that you have a BOI exemption. Another important thing to account is if you are a company with related party transactions, or let's say, for example, your annual gross revenue for the year is reaching the threshold, which is 200 million Thai baht, then you have a transfer pricing disclosure requirement. Another thing that we have to point out in Thailand is the difference is on the director responsibility. The company is not just responsible for filing its annual return. It is also the director's direct responsibility to file its annual returns, or else there will be penalties on this one. Then moving on with the sum on what is another thing that is required for companies in Thailand.
So next thing is the top 5 risks that we see from our experience in working with this industry for over 15 years. Number one is the revenue recognition inconsistencies. So this one is about the type of the revenue in Thailand. When you do the revenue record debit and credit, it could be also different. For example, if you work on the project, which is contained in the period of the timeline. So when you book in your financial statement, when you recognize your income, it might not be along with how the auditor sees. So this one, we have to have a clear communication with the accountants and also understand that what is the Thai law allow to do the revenue recognition. But actually, this part in Thailand, we do the accrual basis is quite similar to many countries. But the thing is, in Thailand, we are also have some specific of tax law where we are looking into the different type of incomes. We have 8 different types of income in the Thai tax law. So we have to interpret correctly what is income of your company from number 1 to number 8. Secondly, regarding to the supportive document in Thailand, Thailand is still having a strict of keeping the documents correctly. We are having some plan, the government having some plan to do online document more in the future. If you have heard about that, we have the e-tax invoice or we have the e-withholding tax, but right now it's not enforced any company to do it yet. But if you want to do, you can also do the registration with the revenue department. But right now, the keeping the actual document is still mandatory in Thailand. The original of your tax invoice is very important for you to claim the company expense and the VAT credit. So if you have incomplete of supporting document, that is going to be part of your risk where you cannot claim the expense and it will be effect in your VAT claiming or it will be effect to your corporate income tax because once you cannot claim the expense, it became your unclaimed expense going to add back to your revenue and you cannot use as the part of tax deduction. So another one that I want to talk about is the related party transaction. As Marek mentioned before, right? The related party in Thailand, you have the obligation to file, especially the transfer pricing report, when the company reaches to the threshold of 200 million Thai baht per year of the revenue. If you have less, you do not need to prepare and submit it for now. But in Thailand, you also have the obligation that the revenue department can trace back and check your tax 5 years previously. So if you prepare this from the beginning, it will be helpful for you to have the clear explanation of how you set the price when it comes into the point that you have to submit the transfer pricing report and you will not have any risk by then with the auditor or with any related government department. And the last one is the last step audit adjustment is because we have not adjust the audit every month as it's supposed to be. Sometimes the document is incorrect and then you figure it out by the end of the year and then you have to do the last minute adjustment. It's going to affect to your profit also and also how you plan on how you manage your budget. Okay, next slide, please.
Okay, let me go through with you why usually the audit problem comes in too late or we just found out at the end of the year. It's all because most companies think of audit just a compliance. When they operate, when they scale up, when they leverage, audit just becomes part of the things in the background. We don't need it at the moment. We just need it later on. We are not trading all of those things. Those things are the main issue why audit surfaces too late. So what companies do is, okay, they have a compliance. then that's the only time they have to think about it. Then they don't do any cleanup or readiness during the year. It always happens at the end of the year. They don't check their books, they don't check their operations, and mostly another thing is communication with the auditors. They only think about the auditors at the end of the year, or some of them they don't even think about the auditors. But that's also an issue. You should have a proactive communication with the auditor and a proactive approach when it comes to your compliances. Another issue is that we always notice with clients, especially with group compliances or clients with multinational companies or with cross-border transaction, is group policies. When it comes to group policies, what they do is they just copy the group policy. They don't check what is required in Thailand. They don't do local adaptation. So whatever is in the head office, okay, we copy it in Thailand. We hope everything falls into place. But it doesn't work that way in Thailand. Another thing is no clear timeline ownership. What it means is parties pass on who is in charge of the audit. They will be thinking, okay, we have time. The auditor can just adjust or switch in, or let's say sneak into us later on. But that is not how audit in Thailand is. You should have a clear timeline because there are a lot of compliances, documentations requirements, and reporting requirements. Next slide, please.
So comes to if you are the company who are going to do your first time audit in Thailand, what you expect to know and what you expect that you will get. Number one, of course, you have to understand the mandatory of the Thai law requirements, as my colleague mentioned. And what we discussed before on the accounting standard in Thailand is probably different than what you find in another country. And the timeline of submission, the penalty amount that going to raise for failure of submission the audit on the government timeline. So you have to also prepare the documents that the auditors request. The auditor will not only request the tax invoice alone for when they audit your report, they will need to see all the document along the way because they need to check what are the related documentation, and if you prepared correctly or not, they need to know check from the end to the beginning step. For example, you have the revenue that you would like to recognize in your book, and the auditor may request to see the work delivery proof to the your client, because the auditor would like to see if you book the revenue correctly for the period of time or not. So you have to be prepared on getting requests of proper document from the auditor. And another thing that I want to touch is about the process of the audit. In this audit, especially if you do not have the monthly financial statement, we have to start from the bookkeeping process. Your bookkeeper has to do debit and credit and create the first draft of financial statement. If you already have, then it's good. But come into the next step after you have the financial statement draft complete. It's going to be the part of adjustment. When you look into your first draft and then you make the adjustment with your accountant, and this part is going to also take some time to do the adjustment. Next step, you have to send to the auditor to do the review and audit and sign off your report. The auditor will also take some certain of time to do the certification. And the legal department has to also prepare the minutes of meeting, updating your shareholder list, submitting the shareholder list. So all this process typically taking around 60 to 90 days. This is concerning quite a fast audit if you have some transactions. So you have to also concern about the time when you do the first audit. And for later on, for the impact of your fundraising and due diligence, this means that if you are prepared correctly and you have the good and in order audit from the first audit, it is your good milestone of the report that you can use right now or in the future when you want to do the fundraising, you discuss with the bank for the loan, or you show the financial statement to the investor. So this one is the first time audit where you can expect and plan. Next slide, please. Coming to the exposure of risks of the director and the CFO. This slide we will talk more on the management part. So in this part, as we mentioned before, the direct responsibility of audit is not accountants, it's not bookkeepers, it's not the shareholder, but first is the director who has to sign off to confirm the audit and submit this report by the accountant to the revenue department and the DPD. So director is the first one who has to understand all the financial statement if you have everything correctly from the process until the accuracy of numbers in the financial statement. So the risk is sometimes the numbers in the financial statement is one thing, but you don't know all the way along what happened, and when it come into the investigation, it will not be able to have a clear explanation. For example, when you see the number of your cash balance or any fund numbers in your financial statement, and then you would have to be able to clarify on how you approve the fund, how is your expense process and financial process in the company. So this one is all related. It's not only the number in the financial statement alone, should have the proper books and record. It has to be all the process that you have it in place, have the proof, and then you can show into the auditor or the government in the future when it comes into the investigation or questions. In Thailand, if you get the letter from the revenue department that they want to come and investigate your company, that is very normal. Or the company in Thailand will get that letter now or then, but they randomly check all the company. So when you have that letter, you don't have to be worried about that. They just want to check the accuracy, how you do and document you prepare. And last one for the risks of the management that we are facing, this is also related to the record, which is the disclosure of related party transactions. This one I would like to talk more on the transfer pricing and anything that related to the third party, especially with your headquarter and the director. Some of the company having director's loan, so you have to make sure that the director's loan, you have the proper document to support it. You charge and record the correct percentage of interest in your audit report, because in Thailand, you cannot have the loan to the third party without with the zero interest. So this is for the management part. Next slide, please.
Okay, so basically we discuss about the directors and the CFOs risk exposures. Now that you know what are the exposures of these two individuals in the company, the important thing is knowing exposures, you are able to mitigate whatever risk that comes in. To mitigate all these risks, you have to be aware. When you are aware of what is your position in the company, you are aware on how to avoid the issues when it comes to audit. Management usually focuses only on P&L most of the time, but then balance sheet account should also be prioritized. Why balance sheet account should be prioritized? Because balance sheet accounts indicates what are the things that the company own, or what are the things that the company owes. So basically it highlights your assets, it highlights your liabilities, it highlights your equities. In this sense, if these are not reconciled, then your balances are not reflecting the correct account of your company. Then, if your balances are not reconciled, your aging of your accounts receivable and accounts payable are not reconciled, it will be harder for you to safeguard your assets or safeguard your profits and to maximize your returns. Piso mentioned about budgeting a while ago as well as transfer pricing. So if your accounts are properly managed, you are also able to manage your transfer pricing policies, your accounts as well on that matter, especially your budgeting when it comes to your management accounts. Another thing that is worth mentioning in Thailand is supporting documentation. When it comes to supporting documentation, it doesn't just go about, let's say, invoices or receipts. It goes beyond that. It also has to cover industry or business specific supporting documents. Let's say, for example, for retail companies should also maintain their inventory valuation reports or records, not just at the end of the year, but also throughout the year. In this way, so that when the auditor requests for your inventory, you just don't run over to your stock house and check your inventory. Another thing is you also have to understand the audit timeline. You have to agree with your auditor on what is the audit schedule, not just your side as the management, not just the auditor side, but both of the team or both of the parties should also agree on this one. Another thing that I want to specifically touch on is the tax position of the company. The tax position of the company is very important to understand. There are companies which have tax credit when it comes to their, let's say, VAT returns. When you have a tax credit, this is your asset which can be carried over throughout the year and until it's extinguished. Another thing is your net loss carryover. You also have to understand if you still have your net loss carryover, which can reduce your tax accountability. So these are the things that you have to understand in order for you to be ready when it comes to the year-end audit of the company. Another thing is, next slide, please. So another thing is, what is a pre-audit cleanup? So a while ago, I mentioned is about awareness. So this is also part of awareness. When you are aware of what your accountabilities, what are your risks and exposures, you are able to check on your audit. So when you understand what comes next, you are able to avoid last minute surprises. It's not just at the end of the year that you have to pay this amount of money, this amount of penalty. But if throughout the year you are checking on your audit, you have readiness, your tax position is established, your budget is most likely clean, and there's no pressure with the finance or the management. Another thing is fees. When we talk of the business, we are always on the fees, the cost, the revenue, and the budgeting. So when audit is clean, somehow you're able to safeguard whatever profit that the company will have, as well as you will be able to schedule or you will be able to manage all your costs. Another thing is audit is also a part of what most stakeholders are checking, what banks are checking, what investors are checking. If you don't plan your audit, let's say, for example, you want to loan money from a bank, or you want to sell your company, or you want to go into M&A, the thing is, if you don't have a clean audit or your audit is late, that is already an issue with them. Let's say it doesn't reflect a proper management of your company accounts. Next audit, please. Next slide, please.
Okay. Before I start with the group audit, I would like to add some more issue that Marek explained before regarding to the laws that you can use. So if you manage this well and you review your tax exposure, you can use your loss carry forward by 5 years. This is the rule in Thailand that you can use. So make sure that when you do the tax calculation, you use the loss carry forward correctly, because if you do not use, you cannot claim it back from a revenue department. They give you one chance to use by the end of the year, and then backdate for 5 years, you can use carry forward. So keep in mind on that as well. Okay, this slide we are talking on the group audit for the company who have the headquarter in in globally or in regionally, and you have to consolidate the audit into one master audit, which many of the group they always do. So first thing first is, again, the Thai standard is going to be the one that you have to understand, because it's different than the IFRS. So if you do not clear with your accountant and all the booking, shut off account and the way they book and the details is not supportive to the IFRS, then when it comes into the consolidation process, you can have an issue for that. It would take time to go back and create the document and create the details, doing more report just to align with your group. The one thing that I would recommend is you share your group audit instruction to the accountant from the beginning of the year. So many companies share the group audit instruction to the accountant when it comes after the year end and on the season that the company has to do audit. But then it might be too late. But if you share with them, for example, right now, you share your group audit instruction, which you have. If you have some adjustment at the end of the year, it's going to be fine, but you can use the standard one that you used last year, share with your accountant, so they know in which method that they have to do the booking and in what information that they have to prepare. And once it's coming to the year end, then they have proper details to fill out in your group audit. And when it come into this process, the communication is very, very important. Language, of course, you have to make sure that forth and back communication is clear, and what auditors from overseas want, it has to be communicate to the Thai accountant correctly, because many of Thai accountants, they might not be familiar with what you book or what you do in the group level. So this is the part of group audit instruction. Just mainly it's just for understanding the need from both sides and then sharing the group audit instruction fastly in the beginning of the year and agree on the timeline. In Thailand, our timeline for submitting the audit is 150 days after the accounting year end, and your group audit might have some different timeline. So you make sure that you communicate with the accountant correctly from that. So next slide, please.
Now that we understand about audit, about compliances, about risk exposures, and what are our tax position, comes in is what is a strong audit partner. A strong audit partner is something that the company needs when it comes to just budgeting, when it comes to understanding its accounts. So a good auditor is not just someone who asks the right question, but for me, a good auditor as well is someone that asks the question but also understands and answers the questions even before they pop in. So basically, your auditor should not just know what is in the textbook, what they have learned, but your auditor should also have industry and technical experience. It's very important to have that with an auditor, because if an auditor, let's say for example, if an auditor just understand a certain industry, if an auditor just have a local understanding of the company in Thailand and they don't have any understanding of how other countries work in, or let's say going back to what Tison was mentioning a while ago about group audit, it will already be a challenge for the management how to communicate with the auditor. Another important thing is if an auditor does not have clear or does not have any exposure with other kinds of industry, their sampling methodologies, their materiality level will be very different from the standards. They will either be lenient or they will be either too prudent or too skeptic. And this will be an issue with the management. Management will be asking why the auditor is too strict, or why the auditor is like too chill, or the auditor is just too lenient with everything. So this one is very important, that you have to choose the right audit partner for your management or for your company. Another thing to consider is a good auditor is someone who understands the engagement, the scope of work, and the risk involved. In this way, when they know what they are going to do for your company, they already plan and they already know the fees. You won't be asking them later on, or they won't be asking you for additional fee later on, because prices are already clear in the beginning. Another one that you need to consider is for group audit, or for the group good auditor as well, is there is a clear working schedule, or the audit working schedule. This working schedule is, when reports are to be submitted, when reports are to be received from their end. Another thing that you have to consider is when you have group auditors, or when, like what Pisam was mentioning about a while ago, is the instructions. if you are doing cross-border transactions, so you have a group auditor that is coming from another country and this is Thailand. So another thing is about communication as well. If you have different auditors or from the beginning you change auditors and you or your auditor has other partners, that will be a challenge for the company. A group auditor or a good auditor should also be able to communicate with you properly, and there should be a single point of communication. It's not that you don't know who to ask or you don't know what to do. So basically, to sum it up, a good auditor is someone that supports the company and adds value to the company. This is not just someone who signs off the financial statement or just a vendor, but this should be a partner of the company that enables the management to make confident decisions. They make clear direction when it comes to their management. Next slide, please.
Thank you, Marek. And I will summarize our webinar today on a few key takeaways that we discussed on this session. So most of the audit stress is not coming from the auditor. Why they ask a lot of questions, but I think it's come because we do not understand and we not prepare enough what the Thai auditor would expect. So if we prepare it beforehand and we understand it from the very beginning, it will help a lot. And for everything that we do, of course, the cost and outcome, this is one of the management looking for, right? We want to save costs. We want to have the good outcome. If we not have the proactive preparation, auditing process can extend more costs, can incur more costs. You have to do the adjustment. You have to, it's not only the money that you have to spend on that, but it's on your resources that has to go back date and then do the adjustment. And then the one thing that we are talking today, and is the key takeaway, is management, especially for the director, is the direct responsible person on the audit in Thailand. So be aware of that. Ask a question to your team if everything is right, trying to understand all the process. It's good for the director and the CFO that when we look into the report and then not only the cost in the end of the year, how much we have to pay tax. But if we have this proper plan, we can also make the decision along the way. We can see, we can track if what we do in this quarter, this month is matched and aligned with what we budget last year or not. And number 4, the key takeaways that you should consider for today is the group audit instruction. If you have the group level that you have to submit the report to them, make sure that it's clear communicate to the Thai accountant. And of course, being the right partner for audit, ask question to your auditor, make sure that they give you the explanation of your financial statement, understand your books, let them help you. If you issue something incorrectly, then they let you know that you have to make some adjustments so you don't have the headache by the end of the year. And the last slide is, so next step from us, we also have the audit readiness guides where you can download, and you can also book the free consultation with our advisor if you want to know more about audit, or you want us to review on your current situation and you want to do some transition, or sometime that you have some transaction that it haven't done 100% correctly before, and you don't want to get some question, or you don't want to have an issue with the revenue department, how do I fix that? Then we can figure it out with you and we can work with you on that. And we would keep, and the consultation will be very confidential. So make sure that we can help you from there. And lastly, I would like to close this webinar on that many companies, we look at the audit as compliance, but I want us to look at it as a tool or a part of business management where we can have this good tool to look at our balance sheet, to trace of what we are doing, if it match with our budget and what to do the plan over this quarter or next quarter. We can prepare everything from here. We are not talking about only the audit of year 25 that many companies is doing right now in the 2026, but we are talking about the audit next year where you can plan ahead from now, so you have more accuracy and more good report in the year end when you do the audit. And next year, everything going to be faster, clearer, and you have less question from the auditor, less headache. So I think the session today could be a benefit for everyone more or less. And if you want to get in touch with us, you can let us know anytime. And next is going to be the Q&A.
Thank you very much, both Sam and Merrick. Yes, so at the beginning, I mentioned we do have a Q&A button at the top here. If anyone would like to ask some questions right now, we'll give you a minute or two to type those out. All right, so we haven't received any questions yet, and we don't want to keep everyone waiting too long. So I want to share that we are going to be sending an email after this session. And if any questions come up, you are welcome to contact us or reply to that email. Otherwise, I want to thank everyone for joining us today. Thank you, Sam and Christina, for giving us your time and your expertise, and I hope you all have a great rest of your day.
Thank you everyone. สวัสดีค่ะ
Thank you.